Good morning all and welcome to today's video. So today I have just the one pair on watch, and that is dollar Swiss. Just to say that I took sugar USD and pound dollar off of watch. If I just load up sugar USD, I can show you why I took that off of watch. So I broke this down yesterday. I've broke this down in previous videos. If we just drill down to the lower time frames, you can see I was looking for this. So we had on the lower degree, feel free to, if you want to know the higher time frame analysis, feel free to watch my previous videos. But basically we had this reversal structure. We had this 1, 2, 3 which lined up with there, and then we had that middle section within it where the impulses within the middle section were of a similar length, giving me a clue that this was likely a completed piece of structure. We pushed down, and then I was looking for, if I just unhide the forecast, yesterday's forecast, I was looking for continuation. I was looking for corrections within here. Okay. And this is one of the reasons why, in a lot of cases, we look for the push down and the flag to mitigate the chance of this happening. There wasn't, even if you'd have taken a risk entry from the top here, there wasn't an entry. But you can see that has been invalidated now. Now, as I said to you before, it's not about, you can have the cleanest structure in the world, such as that of sugar USD, and still it doesn't provide you with an entry and doesn't do what you're anticipating. And then people say things like, what did I do wrong? Well, you didn't do anything wrong. It just, the market had other plans. Okay. The market doesn't have to do anything you want to do, even if the structure dictates that it will, or will likely will. Okay. So now price looks like it's pushing up again to test these highs, because we've had an impulse correction, potential continuation. And if continuation leg was to complete and we measured the impulse, that would take us up into these areas here, or somewhere in that region, where we would likely have that, something like that. We have, to some degree, we have a bit of a middle section there, but the lengths are not proportionate. But more, one of the main reasons this is off of watch now is because if that was to occur, we'd be back above here. We'd be back above the higher time frame area of liquidity, and to me that is just chasing it. Once you start trading above all of the areas of value, if you're looking to get short, then you're chasing a position. And as I've said previously, if we're up in these regions, bearing in mind as well that sugar USD doesn't open, the market doesn't open until I think 9 or 9:30 in the morning. It's 5:45 in the morning as I speak. So even but this wouldn't even open for another few hours, and then it would, if it pushed up to here, the market closes, I believe, at about 5:30. So sugar USD is one of those pairs where it has less opening hours than the Forex market, which is partly why we primarily trade Forex. So just parking this to the side for the time being, we could even get something like this. We could even get some kind of, where we get a bit of a near miss, get some kind of middle section, then we push up to that area, tap in, and then go. We shall see. But as I said, one of the things why the failure rate in trading is 95%, or so Mark Douglas claims, in trading in the zone, is because many people know how to place winning trades. They have a system or a strategy or some kind of rules which allow them to do that on a consistent basis, but they can't stay out of trades when the market is quiet, when the market is correcting, when the market is developing new structures. And that is one of the reasons they give all of the money back, or certainly a lot of it. Okay, and then they end up frustrated and then moving on to another strategy. This is most definitely one of the times where you would want to be patient as a trader. Okay, the market is consolidating. Okay, so we need to be patient and be aggressive when the market permits. If I just tell you why I took pound dollar off of watch, you remember yesterday I was looking on the lower time frames for price to tap into this area. We didn't quite tap into it. Last night, although it was aggressive, I was looking at this as a potential middle section. So we had this 1, 2, 3 move down to there. But typically speaking, if this is a middle section to push up to here, we wouldn't usually see such an aggressive move like that. They're not normally aggressive if we're going to push up to tap into the area to then get short. Okay, so there was always a chance that we would consolidate below the low. Now, I do like these consolidations below the low. Okay. So where we can basically, when we get a tight flag below the low, so when we get something like what we're seeing now, okay, because what can happen is we can typically use all of the volume that's been built up within the larger structure, and then these tight flags will typically play out because the volume that we need for that leg to the downside has been built up within the larger structure sat above it. However, I'm always asking myself, is this a higher risk trade or a lower risk trade which I'm placing? Okay. Now, to me, this would be whenever you've got a liquidity point set just above, be it, whether it's, something like that, or whether it's something on the flip side, like what we've got now, something like that. If we've got that set just above, that increases the risk, because if I was to get short within or on the break of a position such as this, so if I was to get short, let's say on the break, okay, what could likely happen is that you are tagged in, tagged out, price then retests the previous low, does something like that, and then drops. Okay, so this would be a higher risk position, so I wouldn't be looking to place a trade on that. And what I was also going to say is that, yeah, that's what it looks like to me. It looks like it's doing something like that. What I was going to say, I had a blank then. What I was actually going to say is that if we did get that, it wouldn't be, if you just count the candles at the bottom of the screen. I don't really trade past about 6:30 at night on a Friday. Normally my cutoff time is 7:30, but on a Friday, when the market tends to wind down slightly earlier, I don't tend to trade past 6:30. Now, with a pair such as Sugar USD, with a pair like what I'll be looking for on dollar Swiss, if it's the case that, all we need is one candle to push down followed by continuation, then it's likely that setup would be likely by the end of the day. But if I'm looking for something like this to consolidate sideways for a period of time to give us what we're looking for, then by definition that wouldn't be ready by the end of the day. Okay, so I'm just going to park this one as well now. Just to let it develop. This is another example of just letting price do its thing. What we're looking for is not shaping up, so just leave it alone. Trading can be as simple as that. Just leave just leave the pair alone, and then just move on. Okay, and reconvene at another time. So this is another one. I've got dollar Swiss on watch. I don't anticipate this being ready by the end of the day. It's just one of those which is a bit of a hedge, just as an outside bet, simply because I have nothing else on watch besides this. And that doesn't mean that I'm just going to jump in because there's nothing else shaping up. It just means that I've got nothing else on watch. If this did shape up, it would be a super high quality trade, but that doesn't mean that I think it's likely to happen. So on the higher time frames, we have a series of near misses up here. We have a near miss to here and a near miss to here. You've heard me talk about often how these can be filled, which is true, but we are clearly in a run of momentum to the downside. Okay, we broke above this high at a weekly high, and then we crashed back to the downside, giving me a clue that we will likely take out this low here. And if we do, likely take out this low here, which this low failed to tap into last time around. So we have a near miss to the downside. So when we're much closer to a near miss to the downside than we are to one up here, especially when we've broken above a weekly double top and then smashed back below it, I'm satisfied that we are not going to take out these near misses until we've taken out this low here and taken out this one here. That is the higher time frame picture, and then we would kind of complete this 1, 2, 3 touch structure here, which has a 1, 2, 3 middle section before potentially taking out those near misses afterwards. So that's the higher time frame thesis. Okay, you can see that we have this expanding pattern. So we have this where we have a 1, 2, 3 middle section. So we have lower lows and higher highs. If I just drill down, you can see that more clearly. We have a 1, 2, 3 with a 1, 2, 3, giving me a clue that this is a completed structure, where, especially when it taps into an area of liquidity there. And of course, we move to the downside aggressively. Okay, we have a similar thing on the lower degree. So when we see patterns within patterns, that is a good sign. There is an inflection point. I'm not so concerned about this on the 1 hour chart, but we have that 1, 2, 3 with a 1, 2, 3 middle section, giving me a clue that this is likely a completed piece of structure and that we will push down from there. And we do. Okay, we then have this kind of 1, 2, potential 3 move. And if we just measure the impulses, measure it from there and measure it from the break, because the volume built up within the correction can dictate how far we will likely go. That would take us down to these lows, so that makes sense. If I just measure the impulses within this correction, okay, so within an impulse correction continuation, we also usually have impulse correction continuation, and within that, we, to some degree, if we just drill down to the 15-minute chart, we have this impulse correction continuation where the impulses are of a similar length. And even if we measure this impulse correction continuation, so what I'm trying to determine is where these moves have finished. Okay, if we just measure that, if I can get hold of it, there we go. That takes us up to where price is stalled now. So what I'm trying to determine is where some of, this 1, 2, 3 has finished within this potential 1, 2, 3. Okay. However, this is quite steep, and we don't normally see corrections this wide so early on in a move to the downside if we are going to push to the downside. So that is, and we don't normally see middle sections which are impulsive in nature so much. Normally, it's more of a sort of corrective move like that. Okay. So because of the fact that as well, we've not really reacted from anything, okay, on the left. So it's fairly steep. If we were to push down from here, which is what I will be looking for today, but because we wouldn't have necessarily reacted from anything from the left, okay, I'll be looking specifically for a 1 hour flag. So if we break back below this area of value and we flag, I'll be looking for a 1 hour flag. So what that means, this is to mitigate risk. So when we have these kind of steep structures and we don't really react from anything from the left, and with all the other things considered, what I look for is a push down followed by a 1 hour flag, which means 6 to 8 corrective 1 hour candles before I look to get short, versus what I would normally look for, which is 6 to 8 corrective 15-minute candles. And that's basically just me mitigating risk, decreasing the likelihood of me looking for a little 15-minute flag, and then I'm tagged in and then tagged out, and then price pushes up to these highs because it didn't find liquidity from anything from the left. Okay. And here's another reason as well. Okay. So that's what I'll be looking for today. A 1 hour flag, 6 to 8 corrective, a push down below this area of value followed by 6 to 8 corrective 1 hour candles. I'm not concerned about this trend line anymore, because this, if we did get that, this would be a completed piece of structure. So this trend line doesn't hold any weight anymore. Okay. But I'll be able to manage this down to this sharp hook point here, which price moved from aggressively last time around for something in the region of 3.5%. Okay. And one of the reasons that this may not shape up at the end of the by the end of the day is not just because it's a 1 hour flag I'm looking for, which would take a little bit of time to form, but because if I just show you the DXY now, the dollar index, if for those that don't know, is the inverse of euro dollar, right? Now, dollar Swiss often looks a lot like the DXY. The dollar. If we just look at this, you can probably see the similarities to some degree. Now, if we just analyze the DXY, okay, what we have is this one. So we've come from a move up. Okay, so on the higher time frames, we're looking for this impulse correction continuation to push lower. But what it looks like on the as we drill down is it looks like we have a near miss to this high here. It looks like because we have a 1, 2, 3, which has a 1, 2, 3 middle section within it after the second touch, it looks like what we're doing is pushing up for an impulse correction continuation to take out this high for that longer term move to the downside. And then this would become the middle section within this 1, 2, 3. Okay, so that's what it's looking like now. Because dollar Swiss and the DXY move very similar to each other, my entry on dollar Swiss may not shape up. Okay, so we may be coming back in to test this high here and potentially test this high here as well. And if that happens, if we just analyze the lower time frame structure of the DXY, so we've had that 1, 2, 3 with that 1, 2, 3 middle section, which I just showed you. We broke back above this low, and then I was anticipating exactly what has happened here. Okay, so we have this 1, 2, 3. After a move up, we break below, tap all the stop loss orders and the liquidity, and we have that 1, 2, 3 middle section. Okay, and a 1, 2, 3 leading down to that area where the impulses are of a similar length. Okay, so these things that we look for repeat themselves statistically. So now this looks like an impulse. Whoops, wrong tool. An impulse correction continuation to push higher. Why do I think that as well? If we just analyze this high here, okay, so if we just analyze that high, we're kind of correcting above that high as well, suggesting that price did not find enough liquidity here to send it back to the downside. Most likely because this is a completed piece of structure. So I'm anticipating the DXY. It looks quite clear to me with an impulse correction continuation after an impulse correction, potential continuation to push higher. I'm anticipating the DXY to push higher. And of course, if that happens, if it happens aggressively, we may just see dollar Swiss, because it's also worth noting that we've had an impulse correction above here, suggesting that maybe price did not find, even though the proportions of these impulses within this makes sense. Price, you could argue that price did not find enough liquidity at this high for it to break back beneath here. Okay, and that would make sense given that there's nothing to the left that price actually tapped into, which would warrant it pushing to the downside. So this is just about being neutral and being open to the fact that the market can do anything at any time. So if the DXY does push higher, it's also likely that we may get something like this on dollar Swiss, which then pushes up to test these highs again. Okay, and then that would make sense. So that is just what I'll be looking for today, and that is just me trying to give you a more neutral overview because of the fact that the market just looks like it needs more development. But anyway, folks, I hope you've taken some value from this. As I say, the trading is not just about trading; it's got a lot to do with psychology. And one of there's ways that I keep myself neutral away from trading. Okay, so when people talk about trading strategy, they think about technicals, and I'm sure if you've discovered my videos on YouTube, you've gone on, you found them because you were looking for technical tweaks. Well, there's lots of things that I do in my daily life which don't involve trading, which are designed to complement my trading. For example, in the morning, I utilize something called the window of opportunity, where I spend the first 15 minutes of my waking day thinking about things that I'm grateful for, and to some extent thinking about my bigger vision, my longer term goals. Okay, then after I've done these videos, I work out for just over half an hour. It's cardio, not weights, just cardio. That seems to improve my concentration significantly. After that, I have green tea because it's a natural anti-inflammatory, and I have an inflammatory skin condition as well, so it helps with that as well. It helps relax the joints. Then I go and have a cold shower, which is good for growth and repair and all kinds of stuff. I find that particularly good for concentration. Okay, having a cold shower. I do notice the difference. Any lethargy I feel in the mornings after I've woken up, that goes after I've had a cold shower. There's lots of benefits to do with that. You can research them for yourselves. Then I go out and walk my dog. I specifically go out and walk my dog without my music on because I like to stay present and in the moment. That helps me to stay present and in the moment when I'm trading, because it means I don't blindside myself to things that I've learnt to see, which are just end up invisible to me. There's lots of things that I do. I usually do my meditation in the day, but I'm not doing it at the moment because I've gone deaf in my left ear for some reason. Don't ask me why. But anyway, folks, just thought I'd give you a slightly different take. Have a great day. Have a great weekend. and I'll speak to you again soon.